Let's welcome in the team from Charles Schwab. We've got Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research, and Kevin Gordon, Senior Investment Strategist at Charles Schwab. Thank you so much for joining us, Kevin. I'll start with you because you're saying that this concentration risk is putting up a little bit of a yellow flag. So a bit of caution, not hazardous just yet, or ringing alarm bells, but why is that?
Yeah, I mean, the caution, and anytime you run into this, it's not the first time this has happened, where you look at whether it's the Mag 7, whether you're looking at the 10 largest stocks in the S&P 500, however you want to slice it, you're right near record highs in terms of the share that they have and their weight of the market cap for indexes like the S&P 500 or even some of the Russell indexes. So it's a yellow flag in the sense that for investors who find themselves a little bit more exposed to those sectors or those names, you can get outsized move in indexes whenever those few stocks or those handful of stocks have pretty outsized moves, and that's really what you've seen over the past I'd say month or so, where it has been more of an exacerbated move to the upside by the mega caps, a little bit more of a lacking, of a weaker move down the cap spectrum, even within the S&P 500. So even in the large cap space, it's been really just those few names that have really propelled the indexes higher. And I would add, not even across the Mag 7 sectors, the three of them, it's actually been a little bit more concentrated just in communication services. So it's not a bad thing in and of itself, because you've still got a pretty healthy percentage of companies in the S&P that are trading above their 200-day moving average. So you haven't seen a remarkable deterioration there. But if that did happen and you continue to see the indexes push higher because of that mega cap bias, that's where you'd start to get more of a negative divergence, which history would show and is pretty consistent with the fact that that would be probably a more negative backdrop for the stock market.
Yeah, I mean, as you say, the gains we've seen in mega cap, I mean, it's not unjustified, particularly when you've got, the earnings looking good, some of the capex numbers they've been throwing out there. The AI story remains very much intact. But, some traders do sort of suggest that maybe some of the gains we're seeing there is masking some of the weakness in other parts of the market. But let's see what we get today as far as some of the rate cutting expectations. And let's get over to you now, Kathy, on that point. I mean, how are you watching the bond market today in light of that?
Well, what we're expecting is a 25 basis point rate cut. I think if they were going to do 50, they probably would have already signaled that. There's a chance, but I just don't think it's a strong chance. But I think the reaction in the bond market is likely to be one of more, yield curve steepening, which is what we've seen most of this year. The Fed has the problem that they'll be cutting at a time when inflation is well above target and moving higher. And actually, the unemployment rate at just over 4% is still within the region of full employment. So they're going to have to justify this as expectations for inflation coming down and the economy slowing. But I think the market's already built in a lot of rate cuts in a fairly rapid period of time. And the long end of the market may react with, we knew that was coming, but we're not really sure that inflation's doing so well. So we might see short rates continue to come down and long rates kind of stay where they are. I don't expect a big rally in the bond market unless the economic projections are really dire. And I doubt that that's going to be the case.
Now, speaking to Kevin Green about some of the housing data we've been getting, and also with regards to the mortgage apps, seeing an uptick there, the fixed rate dipping and coming off that 6.49 level. I'm just wondering, what this is going to mean for housing demand, Kathy.
Well, I would think any drop in the mortgage rate's going to be helpful, and I think Kevin can probably chime in on this because he's has more knowledge of the housing market than I do. But I'd say any drop in the mortgage rate is going to help the housing market, which has been pretty moribund because of the fact that people just aren't moving who have low mortgage rates and the prices are high. So affordability has been a problem.
Right. I mean, Kevin, do you want to weigh in there on that as far as, some of the expectations moving into today and particularly in light of the data that we've been getting?
Yeah, I mean, Kathy is right to point out that, you probably get, all else equal, you do get more of a bump in housing demand probably if mortgage rates start to roll over. And it's not like there haven't been signals from housing in literally every corner. I mean, even this morning with building permits and housing starts data, permits in particular have contracted for 5 consecutive months, which you haven't seen since the end of '08 going into '09. Not that this is at all, suggestive of a repeat of that period, but the fact that housing starts are also basically trendless and that you have have existing home sales, which is a majority of the market, still hovering near recession levels. Housing is still in its own recession. So yes, I think any aid that can come from the mortgage rate front would be helpful, but we also know that supply is probably the main driver of housing affordability issues right now. So it's not necessarily something that the Fed can fix by cutting rates today or cutting rates a couple of times this year, but at the margin, that probably helps buyers come back into the market a little bit.
Okay, great point to highlight there, Kevin. All right, we're going to wrap it up there. Thank you so much to both of you for joining us. Kathy Jones, fixed income strategist, Charles Schwab Centre for Financial Research, and Kevin Gordon, senior investment strategist over at Charles Schwab.